to check in with one of the big investors, Ares CEO Michael Arougheti. Mike, thank you so much for joining us today here from Berlin. So you have private equity, real assets, private credit. So you span a variety of different asset classes. I want to get your take on the macro situation right now. How are you factoring in things like inflation, rate increases, the Fed decision today into your various modeling with deciding how you want to deploy capital?
There's a lot of cross currents and a lot to think about. Ares invests in over 3,000 companies across the globe in lots of different industries, so the impact is different depending on where we are. I think the good news about Ares specifically and alternative investments generally is we get to play for the long term, and so we have to be mindful of what's going on in the macro, but we don't have to react to the day-to-day headlines. So I would say generally, given the cross currents of inflation, rate hikes, geopolitical instability, we have a generally cautious tone. We're deploying consistently into the market, but I would say generally taking our time.
What are you seeing on the ground, especially within your private equity portfolio? Are you seeing the effects of inflation eat into earnings, perhaps in a way that haven't yet been reflected in public company earnings reports that we've seen thus far?
Good question. The answer is not yet. And I think this is what makes investing in this environment so challenging. We have the benefit of seeing monthly financial statements from all of these companies, and if you look in the rearview mirror, the fundamentals are very strong, and up until this point, most middle market to upper middle market companies have been able to pass through prices. So all of the anxiety and worry is really forward-looking as to what's the future margin picture, what's the future earnings picture, and then obviously that has to get factored into the valuation framework given that multiples are coming down. So it's challenging because everything that you see historically would say things are much stronger than the public markets would tell you.
Yeah, I think that's really important, the fact that you do have a monthly view into this, whereas the public market investor would have a quarterly market view, or a quarterly view. In terms of things like supply chain challenges, labor challenges, are you seeing that inflection point that makes you think that perhaps in the next month or two or three we could see this take place?
It's absolutely real. We've seen the wage inflation. Not every company, but most companies are dealing with wage inflation and some supply chain issues. I think the hope would be maybe with China and broader Asia Pacific opening, we see some relief on the supply side. Obviously, with Fed moves, we're seeing some demand destruction, and the hope is that those two can balance each other out and we can get some stability here. But absolutely, the inflation is starting to show up.
In terms of a buying opportunity, private equity is notorious for being value investors.
Yeah.
They've been sitting on a lot of cash, waiting for the right time. But volatility isn't necessarily the best time to be buying. When do you expect to see that?
We've been in business now. We're celebrating our 25th anniversary this year, so we've seen a lot of cycles. I think the playbook has to be you leg into the cycle. Interestingly, most of the good value now is in the public markets. So even though we're largely private market investors, on a relative value basis, we're seeing better investable opportunity in the public equity and public credit markets. I would expect as the year progresses and the markets stabilize and the private markets reprice, that's when we'll see a more aggressive pivot to the private distressed opportunities. So my sense is back half of the year should get very interesting for us.
Interesting. I have to ask you about private credit. You guys are huge players there, $200 billion in private credit AUM. What are you seeing on that side of things? It's been seen as kind of this haven, so to speak, amid the broader market volatility because you do offer mostly floating rate. Is that market holding up as well as I think people expected?
Absolutely. The same comment I made about the private equity portfolios, same for private credit. And unlike past cycles, we're going into this bout of volatility with an incredible amount of stability within the existing credit exposures. So the market's seen a significant amount of growth for the right reasons, as you mentioned, floating rate interest, high seniority, short duration. So it's an asset class that is almost purpose-built for this type of environment, slower growth, rising rates. So I would expect to continue to see people shifting out of traditional fixed income investments into floating rate private credit.
And you see the demand also from the borrowers.
Yeah, it has not stopped.
We'll keep going. Excellent. Well, that means we will have to have you back on again.
Absolutely.
To get your updated take. Mike Arougheti, CEO of Ares.
Thanks for having me.
Thank you so much.